you have really struggled in understanding how to use the Fibonacci retracement tools to catch trades. In fact, you've tried to use it multiple times and it seems like it's not working. And you've concluded that Fibonacci retracement tool does not work. So you put it on the side. You don't know that what you have kept aside is a lethal weapon. This is a very good tool if you know how to properly use it well. Stay back and listen very well as I'm going to be explaining how to use Fibonacci within short period of time. Just sit back and listen. So one of the mistakes you might probably be making when using the Fibonacci tools is that you are using it in the wrong market. When I say market, I'm relating to trend. You are using it in the wrong trend. If you try to use the Fibonacci tools in the ranging market, the choppy market, you will not get a good result. Fibonacci is meant to be used only, I repeat, only in a trending market. Anything aside that, it will not do the work you expect. That may be the number one factor why Fibonacci might likely not be working for you. So if you are new to the Fibonacci concept, just sit back and you will learn a new thing in this video. Fibonacci is a tool that trader tends to use to catch an ongoing trend. We already know that if a market is going bullish, we create highs and lows. So how do we position ourselves to be able to catch trades from these lows? That is where we have the Fibonacci tools. Same way, if the market is moving in a downtrend, how do we catch this ongoing trend at the highs? That is where we have the work of Fibonacci. So let me just map a trend. So we have a bullish trend creating highs and lows. So if you want to use the Fibonacci in a bullish trend, you need to have a structure like this when the market is going up. So Fibonacci helps you to measure from this recent low to this recent high. So it generates levels that we expect price to respect, and the ongoing trend is most likely to turn from there. This is the Fibonacci tool. I already have the settings on my own here. If you want to make use of this kind of setting, you can just pause this video or screenshots to set yours. So come to style. So these are my settings of Fibonacci. So you can screenshot this, set it with yours. Let me just scroll down. Yeah, so these are the settings I have here. So enough of that. Now, when we mark from the recent low to the recent high, for the bullish trend, you pick your Fibonacci from the lows to the highs. What this basically is doing is just to help us generate support levels. Every concept, every technical trading is based on two things: support and resistance. It is just the way in which they appear that differentiates them. So these levels that we also have here, they are simply support and resistance level. So we have three key levels on my own here. For some other people, you might find two. For some, you might find one. But for my own trading strategy, these three align so well with my concept. So whenever I mark my fee from low to high, I wait for price to retrace. This is where your patience needs to be tested. If price fails to get to any of this Fibonacci level, and then you find that price is looking like it wants to push up, do you know the best thing to do here is to not enter the trade? That is FOMO. That is FOMO. Wait until price comes to you. When price comes to your zone, let's say the 0.5 level or the 0.68 or this level, price will only come to this other two below if only this first one is not respected. How would you know that this level is respected? If price gets there and you spot your entry confirmation, there is no need for you to hesitate. Just place your trade. No need of hesitation. And if you place your trade based on fib, this is another thing that most people don't know. If you place your trade on the 0.5 level, the question you want to ask yourself is, where should your stop loss be? Most people will put their stop loss below that level in which they enter their trade. But when it comes to the concept of Fibonacci, the case is different. Traders often want to be discretionary sometimes, but where you ought to put your stop loss is what you're about to know. Where your stop loss needs to be is below the 618 level, a little bit below the 618 if your trade is being taken from the 0.5 level. Now let's say the 0.5 was not respected, price pushed down to 0.6, and this is where you get your entry confirmation. If your entry is here, your stop loss needs to come below the 0.79. If your entry is 0.79, then your stop loss needs to be below this low that led to this rise. And where is your take profit? I use the minus 0.27 as my profit target on Fibonacci. This does not mean that you have to restrict yourself to the take profit level on Fibonacci. You can still have probably a resistance that you are targeting upward. This is just the simple way on how you use Fibonacci in an uptrend. How then do you use this in a downtrend? You want to be able to identify a downward movement first. So we have this and we are waiting for price to pull back. Waiting for price to pull back will bring our fib from the high. Remember, for the bullish scenario, we take our fib from the low. So when it comes to the bearish market, we are going to take it from the recent high, not the previous one here. The recent high and the recent low. Before you bring your Fibonacci, you want to make sure that price is already retracing back up. Price is already retracing back up. So now you now bring your fib from the recent high down to the recent low, and now you can sit on your hands and do nothing until price retraces to your zone. If price fails to come to your zone, there is no need for entry. Only if you spot another reason why you want to enter that trade. I mean a cogent reason, not just random reason because a candlestick is already pulling down, then you just want to enter the trade. Wait for the market to retrace. The 618 level is usually considered as the golden level. I also love the 618. So when price retraces here, I want to see candle confirmation. Once you get your candle confirmation from the 618, enter for short trade, and your stop loss should be above 618. Most traders don't do this. Do you know why? Because they feel like the stop loss will just be too wide. We always look for a tight stop loss in which that is going to give us a massive risk to reward. That is the reason why trade will eat you out and still head in your direction, because you are not giving it enough room to breathe. So this is how you should set your stop loss based on fib, and you are targeting the next support level in a downtrend. Let me just quickly show you a few examples on the chart, and then you understand how to fully apply Fibonacci. So this is a chart of GBP USD. The chart of GBP USD is not really giving me what I want. So I want to use a current chart. I don't want to use what has happened previously. Okay, now let's make use of this gold chart. You can see on gold has really been on a massive bullish run. You can see what we are having here. This is price. This is giving us what we need. So bring our fib in a bullish direction to the recent low, to the recent high. So when I bring my fib like this, I bring from this low to this high. And now you can see that price come to the 0.79 and we are rejecting back up. You can see how we massively breach both 0.5 and the 0.6, but we hold up at the 0.79. So you can go to your time frame of entry to spot your entry criteria. Maybe you want to see some kind of candlestick patterns, some other things you want to look out for. You place your entry and your stop loss is going to be below here. For gold here now, trader will be like, this stop loss is just too wide. What if I just want to risk little numbers of dollar? You might possibly be risking too high. So they want to be discretionary by like now tightening their stop loss. This is wrong actually, like very, very wrong. That's the reason why the Fibonacci tools has not really been working for you. So you put it where it needs to be. Another error most people do is that they tend to use fib wrongly. If you want to use fib, you need to make sure that price must create a new high. Let's say, for example, let me take what we have here off. So let's say, for example, price pushes up. Okay, let me just go down because I really want to let you learn how to use this effectively. So let me just use a clear chart to explain that. Okay, so this is an upward direction. If you want to use fib, it is a must. It is a must. I repeat, it is a must. Price must break a previous structural high. Price must break a previous structural high. So we have to bring our fib like this. With this, we are going to have so much confidence in using these Fibonacci tools. But now let's now say price fails to break a previous high. So maybe price comes down and pushes up like this. Let's say we have equal high and price is coming downward. You can see what now happened here. Price fails to break this structural high. It is a taboo for you to use Fibonacci. In this case, if it works, you only got lucky. Trust me, if it works, you only got lucky. I know you are learning something, right? You are learning. Very good. Very good. You are learning fast. You are learning fast. If you use Fibonacci in this kind of scenario, it will always fail. Only fewer times it will work. Why? Because price has showed to you that it fails to break a structural high. Same thing in a bearish market. Price is trending downward. We need to be seeing structure breaking to the downside. If for any reason price fails to break structure to the previous low, and we are now coming back, don't say this is still a downtrend. Let me bring out my fib. I will use it to enter the trade. It will not work. That's the honest truth. It will not work. So only take fib when price breaks structure to the downside. Only use fib when price breaks structure to the upside. So that is a bullish example on gold. Let's look at a bearish example. I think I have the market here. Yeah, this is BTC USD. So let me use my chart here. Let's use a different one. This is BTC USD on the 1 hour time frame, and you can see from here this high we have priced up to this low, retracement here, and we are pushing down. In this case, price did not come to the fib level. I was expecting a bearish movement here, so I did not take the trade. I should have taken it with another reason. So you can see here from this high to this low. So I was expecting this pushback to come to any of my fib level, preferably this 0.6, so I can then expect a downward movement. But price fails to come here. That means this is a missed trade because it did not fulfill your trading criteria. I also spot another reason why I should have jumped on this trade, but I don't see that until the market already plays out. So there was a resistance level right here, which I would have used to enter the market, and also there is a chart pattern. I trade price action concepts where I make use of support and resistance, chart patterns, trend line, fibs like this. This is a bearish pattern, a bearish continuation pattern. So this I would have entered without not using Fibonacci. That is just how you make use of Fibonacci in a trending market. It will be very difficult for you to get the best out of Fibonacci when you use them in the choppy or the ranging market. You learned something, right? Now like this video, subscribe if you haven't done so, and follow me for more.